Hi students, my name is Chris and I'm an accounting tutor with Chegg Tutoring. In today's tutorial, we're going to talk about one of the most commonly used profitability ratios, return on investment, or as it's most commonly referred to as ROI. This ratio is used to evaluate the success of a specific investment, to measure the rate of return on total assets. It's an important financial metric for several reasons. One, it can be looked at for asset purchase decisions, or it can be used to make decisions on approval and funding for projects and programs of a variety of types. For example, it could relate to a marketing or advertising campaign, or a company's recruiting initiative, or a training program. It also can be used to make traditional investment decisions. For example, managing a stock portfolio or the use of venture capital funds. The formula to calculate ROI is a simple one, and it can actually be modified to suit the specific situation depending on what is going to be included as both returns and costs. It's important to note that ROI is always expressed as a percentage. So if we're going to measure company profitability, the formula is a very simple and straightforward one. Return on investment will equal net income divided by total assets. If we're going to use ROI to calculate the benefits of a particular investment or project, then we modify the formula where ROI now would equal gains from that particular investment minus the cost of the investment. That result would be divided by the initial cost of the investment to give you the ROI percentage. Maybe the best way we can illustrate this is to look at a couple of examples. First, let's look at example one, which would calculate ROI with regards to profitability. Let's consider the following financial data for ABC Company. They have operating assets of $100,000 and net income of $18,000. So to calculate ROI, we're going to simply divide the $18,000 by $100,000, which gives us an 18% return on investment. Now in example 2, which we're going to modify the formula to calculate ROI for a specific investment. In this case, company ABC is considering purchasing packaging equipment that has an initial cost of $500,000. The projected annual income from this investment will be $120,000 for a 5-year period. So to calculate ROI for this project, we're going to start out with the net income over the period of the project, which in this case is $120,000 times 5 years, which gives us $600,000. From that number, we're going to subtract the initial cost of the investment of $500,000, which leaves us with $100,000. Dividing that number by the initial cost of the project of $500,000 results in a 20% return on investment. So for ABC Company's management, this project is expected to yield a 20% return, and the decision would be to move forward because the ROI of this project exceeds their current ROI threshold of 18%. So as you can see, ROI is a very simple calculation, but one that is in widespread use across businesses for making and looking at many decision points. If you have any questions or need more clarification around this topic of return on investment, my link is below on Chegg Tutors. Please feel free to contact me. And if you have any other accounting topics where you need help or assistance, please let me know. I look forward to speaking with you again on another tutorial, and thanks very much.